Thank you for standing by, and welcome to the AFS Best Practices webinar. Our topic today is Pricing Fundamentals, a review of the 2019 commercial lending landscape, with a special feature, Manufacturing is the Sector Stabilizing. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Director of AFS Business Intelligence, and Jeremy Charlson, Senior Business Analyst, AFS Business Intelligence. We are recording today's session, and therefore this call is in listen-only mode. We do encourage questions. Please use the chat area to ask your questions. Direct your questions to the presenters, and we will leave some time at the end of the presentation so that we may answer as many questions as possible. You will receive an email tomorrow with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Welcome, everyone. Thanks for joining us today for our review of 2019. As we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation. And we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for future webcasts. For your reference, our contact information is provided at the end of this presentation. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS Pricing Service is also used to prepare our monthly Pricing Trends newsletter. If anyone is interested in learning more about our pricing service, or if you're interested in receiving our monthly newsletter, you can reach out to us. Again, our contact information is provided at the end of this presentation. As a baseline for our analysis, we highlighted the key findings of 2019 here on slide 4. Starting with balance growth, the pace of total loan growth cooled considerably in 2019. There is more than one possible explanation for the recent slowdown in loan growth. Trade tensions and the threat of escalating tariffs and a tight labor market impacted business borrowing in 2019 and resulted in lower balances in the manufacturing sector. Aggregate new renewed volume for 2019 was flat, with higher bilateral balances being offset by lower participation balances. Spreads for new loans were higher, while spreads on renewals were flat. Upfront fee levels increased for new bilateral loans. However, upfront fee levels for renewed bilateral loans decreased. And as a follow-up from our last webcast, where there was talk of a manufacturing recession, for our special topic today, Jeremy Charlson will provide a full year perspective on lending to the manufacturing sector. Moving to slide 5, we look at the current environments banks are operating in today. Two leading indicators of commercial loan growth and performance are GDP growth and the unemployment rate. GDP growth in the fourth quarter is expected to come in at 1.8%, slightly off the pace from last quarter. Consumer spending continues to propel the economy forward, while business investment has been comparatively subdued. The national unemployment rate remained at 3.5% in December, the lowest level reported since 1969. And this current economic expansion is the longest in history. Fears of an impending economic recession seem to have subsided, but have not disappeared. Thankfully, the yield curve was no longer inverted as of December. From a bank pricing standpoint, the yield curve remained flat, which lowers rates banks charge on commercial loans. In October, the Fed cut its benchmark interest rate for the third time this year. Predictably, the weighted average interest rate for commercial loans fell in the fourth quarter, as did the weighted average LIBOR equivalent spread. By all indications, competition for loan volume remains intense. On slide 6, we get a more precise illustration of spread pricing for commercial loans. Here we focus on bilateral loans less than $5 million in size. Starting on the left, we can see that weighted average interest rates for LIBOR and prime-based loans fell in 3Q and again in 4Q. The declines were substantial, but also expected, given the Fed lowered interest rates 3 times in 2019. Interestingly, the futures market is pricing a high probability of at least one rate cut in 2020, which would further impact bank margins and profitability. Last quarter, we reported that spreads on both LIBOR and prime-based loans were down year over year. Thankfully, year-over-year changes were not as deep in 4Q. As illustrated by the chart on the right, spreads on LIBOR and prime deals were both down approximately 6 basis points year over year in December, a relatively modest change compared with the double-digit declines posted last quarter. From a profitability standpoint, 2 of the most important drivers of bank margins for commercial loans are the risk curve and the term curve. On slide 7, the chart on the left illustrates the relationship between weighted average interest rates and risk ratings. For this chart, we mapped each bank's internal obligor risk rating schema to the RMA 10-point scale in order to present a standardized look at loan pricing. As you might expect, pricing increases along with credit risk. The risk curve shifted downwards year over year, but continued to slope upwards in 4Q. The curve was very slightly inverted for risk rating 3. The takeaway is that banks are not materially losing standards when it comes to pricing for credit risk. It's a different story for the chart on the right. Last quarter, we reported the term curve was flattening. That trend intensified in 4Q, with rates on loans with a 10-year duration falling beneath the rates on loans with shorter term lengths. Visually, the overall contour of the curve is much flatter in 4Q19, which mirrors the recent flattening of the Treasury curve, the Treasury yield curve. As we saw last quarter, the longer duration loans are not offering the same premium they once did. The dominant story in 4Q was the slowdown in C&I loan growth. We thought it would be interesting to examine this trend within a historical context. The chart on slide 8 examines year-over-year C&I growth each month relative to the long-term historical average. Over the last 20 years or so, annual loan growth has averaged about 4.8%. When the blue line trends above the horizontal axis, that means loan growth in the given month outpaced the historical average. Year over year in December, according to the Fed's H8 report, total C&I loan balances increased 1.6%, the slowest pace recorded over the last 2 years. So while C&I loans are still growing, the current rate is well beneath the historical average. And a number of different financial, economic, and regulatory events have contributed to this growth pattern. Recent trends in GDP seem to suggest that while consumers feel confident about the economy, businesses have a more cautious attitude. The trade war and the uncertainty it has created has had an especially large impact on loan demand in the manufacturing sector. Jeremy will provide more insight into this sector later on in this presentation. Moving to slide 9, there has been much written about the recent slowdown in C&I loan growth. The American Banker summarized the macro drivers of this trend in a recent article. One interesting factor noted by the article is the historically low level of unemployment. Some companies are struggling to find and hire qualified workers in this tight labor market, and consequently are holding off expanding operations. Furthermore, recession worries and trade tensions have hit particular sectors hard, such as automotive, energy, and railroads. On balance, total loan volumes in 2019 were not enough to compensate for the Fed's 3 interest rate cuts, with lower pricing for commercial loans. The authors believe that macroeconomic uncertainty, a tight labor market, and low interest rates will persist in 2020. Other signs suggest that conditions may improve this year. For example, as Jeremy will share with you, headwinds in the manufacturing sector are beginning to abate. So let's see how these market dynamics played out in 2019. Starting with the top left chart on slide 10, we can see that total commercial loan growth of 3.1% in 2019 trailed the prior year's 5.1% growth rate. A slowdown in participated and syndicated lending was the primary driver for 2019's lower total commercial loan balances. Trends in new renewed volume provides one explanation for balance growth. Despite the uptick in December, new renewed volume in 2019 was 2.1% lower than 2018. And again, lower participated and syndicated balances contributed to this decline. Moving to the bottom left chart, we see that spreads on new loans and renewed loans fell slightly month over month. When compared to December of last year, spread pricing for new loans was up slightly, only 10 basis points, while spreads on renewed loans were unchanged. And finally, we can see that as of December, total annualized fees were very similar to the same period a year ago. On slide 11, we take a closer look at balance growth trends. Starting with the top chart, the pace of balance loan growth rose in 2019 to 4.2%, up from 2018's rate of 3.99%. This is shown here by the blue line. Participation balances were up just 0.6%, much lower than last year's rate of 7.9%. Sorry about that. Where we left off, we were saying participation balances were up just 0.6%, much lower than last year's rate. At the bottom of the slide, we dig deeper into 2019 trends and examine variations in balance growth across various loan size ranges. The bottom left chart is focused on bilateral loans. This picture for bilateral loans is one that we've seen many times before. Larger loans, those over $5 million in size, are growing, while lending to smaller end borrowers is down. As we noted in our last webcast, part of this divergence is due to increased competition from non-bank and fintech lenders, which continue to gain market share in the small business and business banking space. For participations on the right, we see the same story, where larger loans are growing and smaller loans are down. Okay, sorry for that delay. We're currently on slide 12. So how can banks leverage this information to gain a competitive advantage? One perspective banks can take is to look externally at trends in the marketplace. This is where benchmarking data from the AFS Pricing Service can help support a bank's growth strategy. The banks who best incorporate market data into their strategic view generally focus on the three pillars shown here. The first pillar focuses on growth. Each month, we look to see which regions are leading the growth in new originations and how loan growth varies by line of business, industry sector, etc. In an environment where net interest margins are under pressure, it is critical for banks to optimize their commercial loan portfolios. Market data can reveal the industry sectors that consistently outperform in terms of risk and return, allowing banks to focus new lending around these high opportunity areas. Finally, while market data can shed light into the best industries and best regions, it is just as important to know which areas of the market are at risk of overheating. You may want to avoid a market where you see rates falling and risk rising, as this is an indication of intensifying competition in that particular market. With these themes as a backdrop, we move to the next slide, where we focus on specific geographic and industry drivers of balance growth. Slide 13 presents the top 5 states and bottom 5 states for balance growth in 2019. These charts are based on the year-over-year change in outstanding dollars to determine the top 5 and bottom 5 states, and then present it ranked by the percentage change. One quick footnote: all of the geographic data presented in today's webcast is based on the location of the borrower, not necessarily the location of the bank booking the loan. The chart at the top of this slide presents a state view for all loan types. Texas reported the largest growth in total balances during 2019, up 9.8%. Here we saw higher balances in the oil and gas extraction subsector, the finance and insurance sector, and in information's telecommunications subsector. We also see California up 6%. The finance and insurance sector and other services sector, more specifically, the private household subsector, were responsible for higher balances in California. Two healthcare subsectors, ambulatory healthcare services and nursing and residential care facilities, also contributed to the higher balances in California. At the other end of the spectrum, balances dropped significantly in Iowa and Kentucky. Iowa reported lower balances in agriculture's crop production and animal production subsectors, and Kentucky reported lower balances in the beverage and tobacco product manufacturing subsector. In the bottom left chart, there's a breakout for bilateral loans. Texas, New York, and California saw balances more than double the national average of 4.2%. The bilateral balance growth for Texas at 12.4% was concentrated in the finance and insurance sector, the computer and electronic product manufacturing subsector, and in the pipeline transportation subsector. In New Jersey, finance's subsector focused on credit intermediation and related activities, as well as hospitals and nursing and residential care facilities, and the chemical manufacturing subsector contributed to the 9.2% increase. On the other hand, Wisconsin dropped 9.7%, which is related to lower balances in the electrical equipment, appliance, and component manufacturing subsector. For participations in the bottom right, we see Colorado and Texas as the top two states. For both of these states, the oil and gas extraction subsector had the largest increase in participation balances. It is also worth noting that the only state to appear in 2019's top 5 for both bilateral loans and participations is Texas. Using the AFS pricing service, you can examine trends within states. Our pricing service is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, on the previous slide, we saw New York in the top 5 states for bilateral loan growth. On this slide, we can see that 2019 growth rate of 7.4% for New York exceeded the national average of 4.2%. And New York and Syracuse contributed to that higher than average growth rate. However, Albany, Buffalo, and Rochester actually lost ground during 2019. This geographic precision allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own markets. On the next 2 slides, we look not only at the top 5 and bottom 5 states, but the entire country. On this slide, we present a heat map for the balance growth across the country. The colors on the map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. The map on this slide focuses on bilateral loans, and we can see that balances were up across most states. As mentioned earlier, balances are much higher in California, New York, and Texas, as indicated by the green shading. Florida is also a top 5 state with higher balances in finance and insurance's credit intermediation and related activities subsector and in the public administration sector focused on executive, legislative, and other general government support activities. However, 22 states experienced negative loan growth during 2019. Many of these states, shown here in red, are located across the top half of the country. Our research identified sharp declines in the manufacturing sector. For example, Ohio balances are down in fabricated metal product manufacturing, as well as in wholesale trades, merchant wholesaler of durable and non-durable goods. In Wisconsin, balances are down in the electrical equipment and appliance and component manufacturing subsector. The map presented on slide 16 changes our focus to the balance growth for participations. Although participation balances were up across most states, 19 states saw balances rise less than $250 million during 2019. And all that red you were seeing adds up to 21 states with negative growth during 2019. In states like Georgia and Kentucky, balances are lower in the manufacturing sector focused on machinery and electronic products. In Georgia, balances are down significantly in the computer and electronic product manufacturing subsector. In Kentucky, the subsectors focusing on machinery manufacturing and transportation equipment manufacturing were responsible for the lower balances in 2019. As the last few slides have demonstrated, there are clearly a handful of geographic markets that have generated balance growth well above the national average. On slide 17, we present a more concise picture of this dynamic. Here, we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. One second. Okay, the assumption here is that a region's level of economic activity is related to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March of 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total loan balances for the top 10 CBSAs continues to grow, climbing higher by 2.8% in the fourth quarter to 22.9%, the remaining markets have been well below this pace, hovering around a 5% growth rate throughout all of 2019. The fourth quarter only saw balances rise 0.1% in the other regions, much lower than the 2.8% increase for the top 10 CBSAs. The implication here is that as business borrowing picks up, the top 10 CBSAs have continued to experience significant increases in total loan balances, and the AFS Pricing Service has the data to help you find where these opportunities exist in today's improving markets. As we move to slide 18, we continue our focus on balance growth and highlight the best and worst performing industries. The finance and insurance sector, which includes activities in securities and commodity contracts, funds, trusts, and other financial vehicles, and credit intermediation, is ranked highest for total balance growth for 2019. The largest growth was posted in New York, Chicago, Boston, Dallas, and in California, in Los Angeles, San Francisco, and Sacramento. The mining, oil, and gas sector is ranked second highest for total balance growth for 2019, with the largest growth seen in Dallas and Houston, and Denver and Minneapolis. Moving to the bottom two charts, we can see that two sectors, transportation, air, water, truck, and finance and insurance, rank among the top 5 fastest growing industries for both bilateral loans and participations. Both sectors are significantly higher than the all industry average for 2019. The chart on the left shows bilateral loan growth, and transportation, air, water, truck is the top industry, especially in cities like Dallas, Orlando, and Atlanta. Finance and insurance is ranked second, and similar to what I mentioned for all loan types, in 2019, balances were up sharply in New York, Los Angeles, Dallas, Boston, and Chicago. Moving over to the participation growth, we again see the transportation, air, water, truck sector. Here we saw significant growth in Tulsa, Oklahoma, and Oklahoma City, and Nashville and Phoenix. The arts, entertainment, and recreation sector is ranked highest, with growth seen in Los Angeles, Columbia and Branson, Missouri, and Dallas and Austin, Texas. A few slides ago, we saw the granularity that the AFS Pricing Service provides users when looking at trends across the country with insight down to the CBSA level. Our pricing service also lets you examine trends within industries. These trends can be analyzed all the way down to a 6-digit NAICS code. On slide 19, we see that within the finance and insurance sector, the credit intermediation and related activities subsector had a positive impact on loan growth during 2019, up more than 20%. Drilling further down to the 6-digit NAICS level, we see that the real estate credit and sales financing subsectors are responsible for the higher balances, while balances tied to the all other category decreased approximately 2% during 2019. Having this granularity is what the AFS pricing service provides, and something for you to consider when you need very detailed data to support your bank's pricing decisions. On the next two slides, we again look across the entire country and present the industry with the largest growth in each state. On slide 20, we focus on bilateral loans. The industry with the largest number of states is the finance sector, shown with the dark blue shading. As mentioned earlier, significant growth took place during 2019 in New York, Dallas, Boston, and Chicago. On the next slide, we change our focus to the balance growth for participations. As with the preceding slide, the industry with the largest 2019 loan growth in each state is presented. We can see that several states are again shaded dark blue, and as you might expect, states like New York, California, Illinois, and North Carolina are highlighted. In addition to examining trends in total balances, the AFS pricing service enables users to analyze trends for new and renewed loans in order to gain valuable insight into the impact of the most recent lending activity. On slide 22, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that we ended the year with higher balances. That is, December's new and renewed loan volumes are higher than last December, with higher volumes in real estate sector and in the wholesale and retail trade sectors. Renewal volume was also higher in the retail trade and real estate sectors, and also in the finance and insurance sector. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of December for new loans of 196 basis points is slightly lower than December 2018, down only 4 basis points. Industries contributing to these lower spreads are accommodation and food services, finance and insurance, and retail trade. The spread for renewed loans as of December is up a modest 3 basis points to 208 basis points. Here we saw higher spreads in the wholesale trade and healthcare sectors. To help demonstrate the competitive landscape that persists in commercial lending, slide 23 looks at the drivers of commercial loan pricing. Two of the most important determinants we see are risk rating and deal size. The charts here show the long-term trends in pricing for bilateral loans by focusing on LIBOR equivalent spreads. The chart on the left looks at spreads across risk. The dotted black line depicts the market average, and we can see the steady decline in spread pricing over the last several years. We know that over this time period, many banks have adjusted their loan mix to focus on better rated credits. However, the overall spread compression is reflected across all risk segments, not just the best rated loans. In fact, the low pass segment displayed the largest average quarter by quarter compression seen over this time frame. A similar picture is presented by loan size on the right. Spread compression was evident across all size segments. The smallest loans, the red line representing deals under $1 million, have experienced a rebound in spread pricing as of late. But when viewed over the long term, this segment, as well as the other segments, have seen spreads fall significantly over this time period. Next, we will quickly look at the volume and pricing trends for participations. On slide 24, the chart on the left shows the total new and renewed volumes for December are down when compared to December of 2018. New participation volumes are down due to sizable declines in the utility sector and in the manufacturing sector focused on machinery and electronic products. Renewal balances for December 2019 are also down significantly. The real estate sector and the professional, scientific, and technical services sector is where we saw the largest year-over-year decreases. Looking at the chart on the right, an indirect relationship is seen for new participation spreads when compared to December 2018. With loan volumes down, the weighted average LIBOR equivalent spread for new participations of 217 basis points is up year over year, while the average spread for renewals fell 2 basis points to 212 basis points. Next, we look at the final layer of our market review. Slide 25 focuses on commercial loan fee performance. This slide provides insight on how frequently upfront fees are assessed, shown here as the fee incidence, and the total amount of fees assessed, or the fee level. The chart at the top left of this slide shows that on a year-over-year basis, the fee incidence rate has not changed for both new and renewed bilateral loans. On the top right, we can see that the fee level for new loans edged higher in December, rising above the level seen a year ago, while the level for renewals was below the level reported a year earlier. As we saw with loan volume and spread pricing, the AFS pricing service enables users to examine the regional drivers of fee performance. Consistent with the prior year, the Middle Atlantic was the highest region in terms of upfront fee incidence, as shown by the bottom left chart. In this region, North Carolina and Virginia posted higher than average incidence rates. The bottom right chart shows that the Western Midwest region displayed the highest upfront fee levels. Minnesota and Missouri reported higher than average fee levels. And now we will transition into our special topic for today. Jeremy Charlson will provide an analysis of economic and commercial lending trends in the manufacturing sector. Jeremy?
Sorry about that, guys. For our manufacturing session, I guess the manufacturing of headsets is not going too well for certain aspects of it. But what we'd like to do is continue what we discussed last quarter, specifically the manufacturing sector and the question of whether or not the sector was in a full-blown recession. It really would have some major consequences for C&I loan growth, since manufacturing is still the biggest C&I industry for C&I lending. So real estate's a little bit bigger, but most of that activity is investor CRE. So what we want to do in this section is explore whether or not the sector is finally starting to show signs of a stabilization. We should note that manufacturing was one of the weakest areas for C&I lending in 2019, but thankfully, though, some of these headwinds that Don pointed out are beginning to abate. So as of year-end 2019, several key performance indicators for the manufacturing sector were giving off several troublesome warning signs. So let's start in the top left corner here. On that chart, we plot the industrial production index, and you can think of that kind of as a GDP measure for the manufacturing sector. Notice that in 1Q19 and again in 2Q19, the quarter-over-quarter change in the index was negative, which technically met the definition of a recession. It did bounce back a little bit in 3Q, but as of 4Q, it again was back in the red. On the top right, we have another key KPI for manufacturing, this one called the capacity utilization. And basically, it's a measure of potential. So for capacity utilization to reach 100%, there would have to be no idle factories or production units anywhere in the US. And notice that this important measure declined every single quarter in 2019. So really not a good sign for manufacturing health. One bright spot in the industry has been employment, and really up until December, employment levels in manufacturing had been steadily rising. Unfortunately, in 4Q, like the other KPIs here, this one is also highlighted red because there was a slight decline in job growth for manufacturing in the latest quarter. Then on the bottom right, we have a measure called the Purchasing Managers Index. I really like that one. It's a very comprehensive measure. Basically, it's an index that surveys manufacturing supply executives, and it averages their responses related to things like new orders, inventories, and production. So it's a really comprehensive way of measuring manufacturing health. If it's above 50, the sector is expanding. If it's below 50, the sector is contracting. And you can see that in 3Q and again in 4Q, the sector was contracting according to the surveys of these manufacturing companies. In fact, the PMI in 4Q19 was one of the lowest that we've seen, I think, in the last 2 or 3 years. So really not a good reading for the manufacturing sector. All of these KPIs are flashing red, which really helps explain in 2019 why manufacturing balances were down, and consequently C&I loan growth really wasn't what we hoped it would have been. But there is hope for the sector in 2020. Not sure if you had a chance to check out the Fed's Beige Book. It's a really cool summary of current economic conditions. And in that report, it has several references to things like abating headwinds and renewed optimism for the manufacturing industry. The Fed did acknowledge that in 2019, manufacturing activity was basically flat across most of its reporting districts, and that hiring did slow for the sector. According to the Fed, the main driver of this trend was the trade war and the uncertainty that it created for many businesses. It also, for many manufacturing firms, raised material costs, which they weren't fully able to pass on to downstream to consumers. Now, in terms of the outlook for manufacturing, the signing of the Phase 1 trade deal between US and China may help to alleviate some of this uncertainty. The terms of the agreement state that China will agree to purchase $77 billion of additional goods and services in 2020, and of that amount, $32.9 billion is focused specifically in the manufacturing sector. So if the agreement does hold true this year, that could be a boon for the industry. Perhaps because of this agreement, many manufacturing companies surveyed in the Fed's Beige Book are a little bit more optimistic about 2020 versus the prior year. So for example, in Cleveland, there were some manufacturing companies saying they plan to increase capital expenditures next year. Atlanta and Dallas, same thing. They expect production levels to increase in 2020. So while the challenges impacting manufacturing have not been fully resolved, I mean, as you saw in that last slide with those red KPIs, we're definitely still in the red. The sector starting 2020 definitely on more stable footing than the prior year. Unfortunately, this renewed optimism arrived a little bit too late to meaningfully and positively impact loan growth in 2019. The chart here plots year-over-year growth rates for each month. And presenting loan growth this way really helps to smooth out seasonality in the time series. So Don spoke earlier about the slowdown in C&I loan growth. And you can see by that dotted black line here, the line representing the market average, that's been trending downwards throughout the fourth quarter. Now, manufacturing, the red series, that was heavily responsible for why the overall growth for the market really trended downwards in recent times. Manufacturing started the year with impressive loan growth, but as of December of the current year, we actually posted a decline. So really not a great way to end the year for the manufacturing sector. Now, as the Fed pointed out in its Beige Book, trade uncertainty continued to weigh on some businesses, manufacturing companies in particular. So the reason that red line went down, I'd say the main reason was for a lot of these companies, the trade uncertainties and the increases in material costs that unfortunately they had to bear. Thank you, Don. Now, a story we've been tracking for a little while now is the divergence in loan growth between small and large loans. And Don had a great chart earlier where he broke out loan growth by size. And what we saw was that loans over $5 million in loan size were growing and still growing at a pretty nice pace. But loans beneath that threshold continue to contract. There are a lot of different hypotheses trying to explain that phenomenon. You know, we've heard things like the rise of fintech lenders eating into the small business and SME space, also the flight to quality behavior of some of the larger commercial banks, a lot of different reasons. But what's really interesting here is that manufacturing is quite emblematic of that broader trend. Within the sector, balance growth for loans under 5 million, which is the green line on this chart, almost consistently declined over the last 5 years. Somewhat puzzling, as there's certainly plenty of potential small manufacturing borrowers out there in the market. In fact, according to one study, 98% of all manufacturing companies in the US, and this figure really surprised me, are small businesses, and the majority of them had fewer than 20 employees. Growth in the larger end of manufacturing, the $5 million or greater size, that blue line here, was more volatile viewed historically. It had some high peaks and some deep retrenchments over the last 5 years. This segment of the manufacturing industry started the year with great growth, actually in the double digits, but by the end of the year, it too also had a decline. Now, given the optimism expressed in the Fed's Beige Book, it's certainly possible that loan growth will recover in 2020 for manufacturing, but it would definitely take a major market shift to jolt loan growth in the smaller end of the sector. Of course, just like any industry, when you split it out by subsector, the growth story is far from uniform. So if you look on the far right there where the red bars are pictured, at negative 22%, furniture manufacturing had the largest year-over-year decline in loan balances. The subsector was hit particularly hard by the trade war with China. In fact, according to Reuters, a typical furniture seller would have to raise the retail price of a table to about $1,000 from $800 in order to cover the current tariff cost. So a really big price hike associated with the current round of tariffs. Similarly, the trade war has also impacted the price of PC parts, which helps explain the sharp drop in lending to computer manufacturers, which is third from the right on this particular diagram. What's fascinating, though, is that the tariffs are not impeding loan growth for several other affected subsectors. So on the very far left here, we have chemical manufacturing. That was definitely one that was hit by the tariffs for many different products, and that sector grew over 10%, so really robust year-over-year growth for that area of the manufacturing industry. Now, having weathered a rough 2019 in terms of output and employment, the manufacturing sector does represent an area of concern in terms of credit quality. We should mention that the banks that we've talked to have not reported many loan defaults for manufacturing borrowers. That's good. And consistent with these discussions, non-accrual levels for manufacturing have remained low and steady. So as you can see on the left there, the non-accrual rate for manufacturing, the red line, it actually improved year over year, and it's actually better than the CNI average. The CNI average is still being adversely impacted by a lot of problems in the energy sector. We still haven't fully moved past that phase of the credit cycle. But right now, in terms of non-accruals, manufacturing's better. What's a little bit more troubling is that delinquencies have trended upwards for the sector. As plotted by the right graphic, the percentage of loans past due 30 days or more was 75 basis points in 4Q19, up 25 basis points from the year earlier period. Now, past due levels are more volatile than non-accruals. Sometimes they do settle down following a spike. So it's really hard to know just what to make of this increase in manufacturing manufacturing delinquencies just yet. We'll definitely keep an eye on it, but not a good sign for the future outlook for the sector. And I just mentioned some of the problems that we're still seeing in the energy sector. Manufacturing, some of the subsectors within manufacturing do overlap with energy. So one of those is the petroleum and coal subsector. And companies many energy companies right now are really struggling to find new sources of funding as banks and other sources of capital have become a lot more environmentally conscious. We keep reading about some new energy bankruptcies in the news. Seems like there's a new one every day. And what's fascinating now is that, the price of oil, it's still low, but it has rebounded from its low peak several years earlier. What's causing these bankruptcies is not a collapse in crude prices, but rather by the burden of a more expensive capital structure. And problems upstream in energy with some of the drillers and services companies in Texas and Oklahoma, that is having a downstream impact on manufacturing petroleum suppliers and coal suppliers. So as you can see on the far left, on the left-hand diagram, the past due level for petroleum and coal manufacturers was very high in 4Q19, almost 5%. That's a really high past due ratio. Similarly, apparel and food manufacturing also had high delinquency rates in 4Q19. All three of these subsectors experienced large year-over-year increases in past dues, as you can see by the change chart on the right. Now, in terms of default expectations for manufacturing, we observed a really interesting contrast between large and small loans in the sector. So for the manufacturing industry, the weighted average probability of default decreased, or said another way, improved, year over year for the size segments below $5 million. Above this threshold, default estimates actually increased or deteriorated over the same period. And since the larger deals in the sector overwhelmingly comprise most of the loan volume, the overall weighted average PD for manufacturing also increased. Now, it's difficult to identify just why this trend happened. One explanation is that larger manufacturers are more likely to have a global presence and be more integrated in global supply chains, and thus they might be bearing the cost of the tariffs more so than their smaller counterparts. A simpler explanation is that the flatter risk size curve here just reflects annual or periodic bank recalibration of risk ratings from their initial estimates. Sometimes banks will say, hey, it's been a year, maybe we should increase the default likelihood for some of these borrowers. It may have been too optimistic at one point in time. So hard to say what to make of this, but a really, again, an interesting contrast between large and small loans, this time from a credit quality perspective. While the weighted average default likelihood for manufacturing increased year over year, this trend was partially mitigated by widening spreads. So on this slide, we focused on manufacturing loans, only those tied to LIBOR, which is really the predominant index in the industry. Right now, we're not seeing a lot of SOFR activity, so LIBOR is still comprising the vast majority of the loan volume. And in terms of how you read this chart, the blue square is the LIBOR equivalent spread for the median bank in our database, and the tails capture the first and third quartile banks. A narrow upper tail is usually a sign that pricing competition is very intense, with few banks able to earn a higher spread than the median. In 4Q19, the spread for LIBOR rate manufacturing loans was 209 basis points, up 14 basis points from a year ago. And to help put that figure in perspective, the average LIBOR loan spread for all C&I industries, so manufacturing, finance, energy, you name it, the all-in LIBOR spread was 109 basis points. So not only is manufacturing posting a higher spread, it's actually been widening over the last year. So while default risk increased over the last year for the manufacturing sector, the industry is at least seeing spreads trend in the right direction. So as 2019 came to a close, there were some signs that manufacturing would rebound in 2020, but nothing concrete has materialized just yet. Various manufacturing KPIs were flashing red as a 4Q, like the Industrial Production Index, and correlating with that, loan balances were down for the sector when compared to the year ago period. Manufacturing delinquencies increased year over year, as did the default probabilities for larger borrowers in this industry. Thankfully, those surveys of manufacturing companies in the Fed's latest Beige Book point to a renewed level of optimism thanks to the prospect of at least partial trade resolutions with China. So I know we're coming up near the end of the webinar, but just one other thing I wanted to show the audience before we wrap up. We've been working on a new prototype report application. We're really excited about it and wanted to share it with you in this section of the webinar. And one question we get a lot from banks is, can you provide us with a simple yet comprehensive picture of the commercial banking landscape? And what I'd like to show you now is an intuitive Excel-based dashboard designed for portfolio managers, product managers, and even executives who need quick, easy access to commercial lending trends and statistics. We're tentatively calling it the BI Performance Dashboard, still tweaking some of the finer points here. One thing I do want to emphasize up front is that this new Excel-based dashboard is meant to complement, not replace, our existing pricing and credit risk dashboard. So if you're a user of our pricing dashboard or our risk analysis service, this is not a replacement for that, but rather a complement to give you some other type of visuals into the data. So in terms of its design, the BI dashboard is organized around 3 core report templates. The first is a bank versus market comparison, featuring commercial loan growth, spread pricing, and deposit information. So on the left here, we have a handful of what we call slicers that allow you to drill into specific geographic areas, deal sizes, and risk ratings. For those on the call that use our existing pricing dashboard, these slicers are very similar to our dimension controller. Then on the right, we have a couple of dynamic visuals that respond to your selections. So you can track your loan growth versus the market in, say, the Philadelphia MSA or a specific deal size. And in that little box plot there, you can see the dispersion across all the banks in our database. Same thing for spread pricing on the far right. It will respond to all your selections and give you a really nice summary of growth versus pricing in your home turf. And then the bottom of that report displays quantitative detail for the specific segments. So you can see growth rates and average spreads for each individual MSA, deal size, and so on. And there's a variance column there that highlights the charts and charts the magnitude of the difference between your bank and the market. Kind of reminds me a little bit of some of the stock tables you see in the Wall Street Journal. Just a really nice snapshot of how your bank is performing across many of its core geographies and lending segments. Now, as we saw throughout this presentation, industry sector is highly correlated with many measures of commercial loan growth and performance. And the second tab in this Excel-based dashboard focuses on opportunities and risks by industry subsector. And we have 6 charts that form the visuals here. 4 of them are credit quality measures, those being past dues, non-accruals, weighted average PDs, and the percentage of loans risk-rated low pass. We also plot loan growth and employment levels, as the latter is a leading indicator for commercial loan growth and performance. What you can do on this report is you select the time period, and our algorithm finds the 10 highest subsectors relative to each KPI. As an example of that, on the next slide, Renee, what you could do using that report is say, well, what if I wanted to see the 10 biggest movers in terms of delinquencies by industry? And on the data table here, what I did is I said, filter for the top 10 items in terms of past due changes. And we can see, for example, that industries like miscellaneous store retailers, mining, primary metal, which is a tariff impacted industry, all of those had really sharp spikes in delinquencies year over year. And the final report we have here is a commercial loan pricing grid, which is our third core offering in this Excel dashboard. It has geographical information on deal flow, pricing, and structure. You know, one thing we hear from the banks is how dramatically pricing can vary across geographic lines. You know, the pricing competition in Chicago, very different than Los Angeles, than Birmingham, and so on. So to give banks more insight into these pricing dynamics, we created a pricing grid that can be filtered for various micro-geographic markets. Essentially, it's a report to help guide lending teams to price more effectively and strategically in their home markets. I'm sorry, go back one, Renee. Apologize for that, didn't see that. And just a quick example of that pricing grid. So what I did here, say you were a bank that had a branch presence in Los Angeles, you can filter the grid just for the Los Angeles CBSA in the top left there. Maybe the loan coming down the pipeline is average acceptable in terms of its credit risk, and it's a line of credit in terms of its product type. This report will then filter for just those variables, and you can then see for all the loans that met that selection criteria, the size and index dispersion, and we also present things like min, max, weighted average spreads, so you can see the full range of pricing in your core markets. Now, this new Excel BI dashboard, it's still in its formative stages. We're calling it a prototype, but we wanted to share our initial design with our regular listeners. So if you have any questions about it, about this presentation in general, or about this BI dashboard, love to hear your thoughts. You can reach out to Don or myself. Our contact information's here. And I know we're just coming up on the hour, so I think that concludes our 4Q19 commercial loan pricing webcast. Before we sign off, I just want to say that many of the ideas were developed through collaboration with bankers on the line today. And both Don and I would like to thank the participating banks for their continued support of the pricing dashboard. And if we have a couple of questions in maybe a couple of minutes, I think we have time to answer a few. Okay. Yeah, we want to respect your time. We know we bumped up right against the hour. If you had any questions about the analytics today or any of the new ideas that we shared, we love to have conversations with the bankers. Again, Don and myself, feel free to call us or email us. Love to chat with you. Thank you so much for tuning into the webinar and for your support of our program.